Hi, I'm here today at Century Financial Group with my preferred mortgage partner, Tim Billups. We're going to chat about mortgages and the market. Start there. Okay.
Yeah.
Thanks for being here, Tim, and for having me in your office. So let's get started. About a year ago or so, rates doubled. Big impact on the market.
Right.
Tell me what's happening now to try to deal with that problem.
Yeah, no problem. Thanks for stopping by the way. For your clients, for those that don't know, we've worked together for, 10, maybe 15 years now. Done predominantly Central Florida, Seminole County, Volusia County, pretty much all over the area. But you're right, John. The hot topic for the past year, going on year, close to a year and a half now, is going to be the rising interest rate market. Let's face it, that's what's driving real estate right now. Rates have doubled, and in some cases more than doubled. So what I want to go over with today are two very good topics, positive topics that help fight that rising interest rate market, and can kind of offer some relief to your buyers as far as the overall monthly payment is concerned. First and foremost, just announced through FHA, exciting new change in their guidelines effective today, March 1st. Is going to be the reduction in their monthly mortgage insurance premium. So for those of you that don't know, FHA is going to charge a monthly mortgage insurance premium. Simply, you're not putting 20% down. That involves a lot of mortgage products out there. With FHA, you're going to have mortgage insurance regardless of the down payment. But there is a factor that goes into that is kind of delegated by FHA that determines what they're paying monthly. Effective this month has been reduced by 30 basis points. So for those out there that don't really understand the ins and outs of that, what that really means is what you will pay monthly for mortgage insurance for that FHA loan is going to be reduced quite a bit.
So give me an example, like if someone were to buy a house for, they got a loan for $400,000, what would that look like? How much would they save based on this new?
Sure. So in a $400,000 loan where your buyer goes through FHA, you're seeing a reduction in mortgage insurance of about $100 per month.
Wow.
So think about that. That's $1,200, $1,300 a year in straight savings across the board for your buyers. That could mean a world of difference for several things. One, qualifying for the home. $100 reduction in monthly payment could mean the difference between your buyer actually getting approved or not getting approved. Second, and just as important factor would be, your buyer may have a mental budget for what they want to spend monthly for a particular home. Dropping that payment by $100 could tip the scales, in their favor for that dream home that they really want to buy. So we're talking about real savings here, straight across the board for the FHA loan. And regarding FHA loans, typically that's going to be your most popular first-time home buyer program for several reasons. The main one is down payment. The majority of your buyers are going to do the 3.5% down. But FHA also has more lenient credit score guidelines. Their debt to income ratios sometimes are going to be a little bit more lenient than if you went, say, conventional or VA. So this is going to directly impact quite a bit of your first-time home buyers right out of the gate.
What about interest rates? Are FHA rates better, worse?
Predominantly, FHA rates are going to be lower than what you would see on the conventional side. But sadly, FHA, just like every other mortgage program out there, has seen a drastic increase in interest rates.
Of course.
This is FHA's way of trying to kind of deal with that and help these buyers, first-time home buyers, if you will, kind of ease that payment burden.
That's a good point. So who qualifies for FHA, just for the people that may be curious?
FHA is going to be first-time home buyer.
Tell me, what exactly are the qualifications for an FHA loan?
Sure, excellent question. So FHA, like I said earlier, a little bit more lenient on their qualifying guidelines. First and foremost, credit score. 620 credit score gets your buyer into that FHA, what we would call the wheelhouse, qualify for pretty much everything that FHA has. But we do have some guidelines with certain lenders that allow for as low as 580 scores. We don't really like to advertise that as much because you need some strong compensating factors at a 580 score. So usually what we'll try to do, if you have a buyer that's a little bit below that 620, we'll offer some type of credit repair. We do that for free, by the way, to try to get that score up to 620 or higher to qualify them. Outside of that, their debt to income ratio guidelines are a little bit more lenient. to get them into that property, as say what a conventional loan program will be. But those two things, John, make that FHA loan program probably the most popular when it comes to your first-time home buyers.
Is there anything else going on right now that's similar to the mortgage insurance reduction? Anything else that's on
Sure.
in the lending world that's trying to give you an edge to compensate?
To stay on the same topic with the rising interest rates over the past year, another popular product, program, guideline, however you want to word it, is the 2-1 buy down for mortgage rates. John, I know you know about this. We talked about this several times in the past. The 2-1 buy down has really been around as long as I've been in the industry in the 90s. And it's kind of a neat way to temporarily ease the pain of these higher interest rates. And the way that works is this. Let's say current market 30-year fixed rate for whatever program you have, FHA, conventional, whatever it might be. Let's say that rate's at 6.5. This guideline or this program allows you for the first 2 years to have a short-term, much lower interest rate. It's a 2-1 buy down. So what that means is the first year after you close, that normal 6.5 rate drops to 4.5%. Year 2, it goes up to 5.5, and then year 3 through 27 modifies back to that 6.5, which is where the rates were at the time of closing. The savings that you will have in that 24-month period are charged and collected at the closing, and they're charged to the seller and or sometimes the realtor. The realtor can contribute. So what it means is a good realtor, such as yourself, John, who I happen to know you're very good at getting seller concessions, can go to the seller and present offers and part of the negotiating and get the seller to give those credits to your buyer. That allows your buyer to have 24 months of lower mortgage payments. So a good example, if we're sticking to the $400,000 loan amount, at a $400,000 loan amount, let's say, where the initial rate's at 6.5%, with that 2-1 buy down for 24 months, they're gonna have an interest reduction of $12,000, give or take.
Okay.
That would be credited to them at the closing by your seller. At that 2-year mark, rate would modify back up to say 6.5. With the hopes though, and this is what the common theme is with the temporary buy down, that the current market rates have gone back down.
And they can refinance.
And they can refinance at that time, correct. And either through ourselves or any other lenders, we can offer no closing cost refinances at a time. So where they're literally for the first 2 years on borrowed time, that's paid for by the seller, and then can refinance at that 2-year mark with no closing costs, if you will, as long as the rates make sense, into a much lower rate, and they get to take advantage of that.
But unlike some of these products I saw in the past, like adjustable rate mortgages, interest-only mortgages, where there's uncertainty, you
Sure.
get that lower payment, but it could suddenly fluctuate. You
Sure.
have no idea what's going to happen.
Yes.
This is more stable because at least they know worst case scenario. Year 3, I'm
Correct.
at 6.5, and I can handle
Correct.
that.
It is a fixed rate mortgage product. It is not an adjustable. The only thing it has in common with the adjustable is the rate does go up, but you know exactly what
You know
the
where
terms
it's
are.
gonna go.
You know where it's going to go.
Let's pick up where we left off at adjustable rate mortgages. So tell me, has that product made a comeback? Is that another product that's trying to help with this current market situation we find ourselves in?
Kind of depends on who you ask. So for me to answer that, you have to understand, and I know you know, but for your buyers, I own a wholesale mortgage brokerage business. So what that basically means is we're dealing with certain lenders, and any given month we're signed up with 12 to 15 of some of the most competitive wholesale lenders out there. But we're dealing with lenders on the wholesale side, which allows us to offer, in some cases, much lower interest rates than your clients going directly to the lenders. That being said, the reason why that's an important fact is the adjustable rates we're not seeing as being that beneficial, not much more beneficial, should I say, as what they've always been compared to our lower fixed rates. Now, some of the banks who have a little bit higher fixed rates, whether it be 30-year, 15, 20-year, they're pushing these adjustables because the adjustable rate is making sense. In other words, it's low enough to where it justifies, short-term fixed before it does eventually modify. In our world, the wholesale world, if you will, we're only really seeing that on jumbos. The jumbo arms are actually very good right now, and in some cases, depending on the lenders, are lower than the fixed rate. So I'm referring to the 10-1 arm on the jumbo rates, which means it's fixed for 10 years, and then after that 10-year fixed period, it can adjust, and usually it will adjust up. But for 10 years, John, they get to take advantage of a lower fixed rate than what a 30-year fixed rate would be.
Okay.
That's beneficial for a lot
But you're
of
saying
buyers.
on jumbo. Now, what, just so people that may not know, what
That
is
would be
jumbo?
any loan amounts above that 726 and change conventional conforming loan amount guideline. And that just changed at the beginning of this year.
Okay. So
Anything
really that's
else,
for people that are in much more of a higher range.
right? And if you think about it too, you know, a loan amount of $800,000-900,000, that difference in, you know, maybe a half a point is monumental, as opposed to, you know, your buyer that's at the $300,000-400,000 you know, price point. Not so much of a monthly savings as it would be for the jumbo loan.
So what other, now that we've talked about that, I know you mentioned earlier something before we started our tape here. You mentioned Hometown Heroes. So that's probably another program to try to help the market, give
Correct.
people some kind of benefit. Can you tell me
Correct,
a little bit about
that? Very excited about that. Been around for going on a year now. Just opened up to the wholesale side, wholesale channel, if you will, for 60 days. But Hometown Heroes is a Florida-specific program that is basically a down payment assistance program that's offered for 50 different employment types. First responders, police officers, teachers, healthcare professionals, etc. You know, too much to go over in this short period. You know, your clients can call me. We've got a long list of qualified buyers. But if they're in one of those selected professions, then they qualify for 5% of the purchase price up to $25,000 as a 0% interest second mortgage, if you will, money to be used for anything, John. So that could be used for down payment, could be used for closing costs, could be used for you know, long-term rate buy downs. Obviously not, you know, not the 2-1 buy down that we discussed, but it is in the form of a second mortgage, 0% interest, not due payable for 30 years. So I don't like to use the word free money. You know, as your buyers know, nothing's for free, but as close as you're going to get to that. Reason why your clients are probably better served on the wholesale side in doing the Hometown Heroes. The Hometown Heroes program is the same regardless of what lender you go to. But going to said bank, if you will, that Hometown Heroes rate is going to always be much lower than their fixed conventional rate FHA would be anyways. Going through the wholesale channel, we can give your buyers an option. You know, here's the Hometown Heroes rate with the 5%, or if you could come up with, say, 3% down or 3.5% down, 9 times out of 10, you will be able to take advantage of a slightly lower rate going through the normal, you know, FHA conventional channels, if you will. But it's good to have that option. But I tell you, with what we're seeing out there, it is really difficult for buyers to turn away, you know, up to $25,000.
Yeah, so let's use an example. Let's say, again, $400,000, we've been talking about that as a loan amount. So that would be $20,000.
Correct.
Right?
$20,000.
Up to 5%, no more than 25 is your
correct.
max. So if you're buying $400,000, you get a $20,000 no
credit.
Interest, no payment loan. It's just a credit that you
Credit,
can
no
use
payment for 30
whatever.
years, correct. And what is probably the most important factor in this, and what makes this, and in my 26 years in the business, the best down payment assistance program out there, is they can use that money for anything. They can use it for, you know, let's say you have a client, John, that's got they've got 5%, for example, down payment funds. You can still take that money, pay off the closing costs. Let's say you're good at doing this, obviously. Let's say you got a buyer that's got 5% to put down, and you negotiated the seller to pay all their closing costs. They can take that money and put it on top of the 5% down. Now they're doing 10% down, get a much lower interest rate, lower PMI factor, and here's the big one, lower interest costs over the life of the loan. So those are things that you can do the number to 30 years if they stay in the house, and you're talking about massive savings.
Yeah.
For a 0% loan from the state of Florida.
But then if they do sell the property in 5 years, they just have to pay
it back. Right. Remember, John, nothing's for free.
Yeah.
Nothing's for free.
But if they use that money as a principal reduction, like you just said, then it's really not even, the equity's there. They built it into their purchase, so when they go to sell, assuming in 5 years or whatever, the price of the value of the property's gone up.
Correct.
And then they've already used the money to pay down the principal, so now they're sitting on that equity anyway. So it's not going to hurt them. They're not going to be upside down or anything like that.
Right.
Well, Tim, it was great speaking with you. Thank you so much for your time.
Yeah.
I'll put some links in the video here so that people that want more information can contact you directly.
Yeah.
And Thank you for watching. We hope you enjoyed it.
No problem. Thanks, John. Always great seeing you.
You too.